Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In this month's LONGWave, I'd like to continue from last month's video where we discussed the possibilities of a coming secular sector rotation where value versus growth became more pronounced. We discussed areas most likely to benefit if this occurs. This month I'd like to expand on that with more of a focus on precious metals and gold specifically. As such, I'd like to discuss the subjects listed here. We have found that since the 2008 financial crisis that spot gold prices have tracked very tightly with the real, and I stress real, yield of the 10-year U.S. Treasury note. This chart shows that correlation going back prior to the financial crisis when it began to more tightly couple. We see that when the 10-year U.S. real rate is rising, the coupling is most prevalent. Since the fall of 2018, when the Mnuchin massacre occurred, the correlation has tightened further, even when we experienced the initial COVID-19 market sell-off noted here in red. Over the month, as precious metals corrected and volatility increased, the correlation continued its coupling. This is despite little movement in the nominal yield value of the 10-year yield Treasury note, circled in red. The movement in real value has been driven by the 10-year inflation break-even and reflected in the TIPS, that is the Treasury inflation protected securities. Skeptics often say real yields can't move any higher. This is often because they're looking at the TIPS market, which only dates back to 1997, and real yields are already at their lows for this time frame. Therefore, some investors assume interest rates, when adjusted for inflation expectations, have never been lower. That unfortunately fails to include one of the most important analogs to today's setup, the decade of the 1970s. Back then, 10-year yields less inflation measured by CPI twice reached as low as about 4.9% negative. Those moments of large and declining negative real interest rates drove two of the U.S.'s most significant surges in U.S. history. In today's conundrum, corporations and governments are historically indebted and can't take higher nominal yields, ensuring that strong monetary stimulus is here to stay to drive real yields lower, just like Fed Chairman Jay Powell has promised. A major narrative shift is underway. The old times of precious metals being perceived just as a haven asset are probably over. With $15 trillion worth of negative yielding bonds, record overvalued stocks, and a historically leveraged global economy, investors will likely begin to look at with a fresh pair of eyes. Growth and value are the only industry where we are seeing strong and sustainable growth in revenues and future free cash flows at still incredibly low valuations today. Investors are starting to take note. For instance, have already started to outperform even the market darlings tech stocks. We believe this is only the beginning of a new era for. As good as the 10-year U.S. Treasury real yield correlation is, it is difficult to use it effectively since the real Treasury yield and the spot gold price are coincident. You have little warning or ability to anticipate other than the technical analysis, speculation on interest rate sentiment shifts, or what the Fed might do that affects nominal yield values. You need something or a tool that answers that question. We have found here at Meta SII that the is just such a tool. Shown in the bottom right has historically led global equities versus U.S. cash to a large degree. However, more importantly, and frankly much more importantly, the tightly correlated. While the financial punditry is preoccupied with the Fed and its $7 trillion balance sheet, whether Powell is purchasing bond ETFs, we are seeing that technical analysis supports this potential surge in Q1, Q2 in real yield rates going higher. Our technical analysis are showing the potential for a classic formation, and an idealized form is shown here for illustrations. Shown here is the long-term gold chart, which we have been tracking at MATSII. It allowed us to spot the bottom and take advantage of the recent lift when we received our confirmation signal, shown in red. We are now at our initial target, having put in and now fully expect we believe this will take the form of before heading. We believe this for a number of technical reasons, but additionally because we see it supporting the gold price adjusted for inflation, shown here, which is interesting, also reflects completing but on a very long-term horizon, going back to the early 80s. If we shift to a larger macro perspective, we need to consider economic principles such as the quantity of money. The following formulas were developed when money was not fiat and backed by gold, making M now obsolete. Economies were dominantly domestic, with exports playing a relatively minor role, making T now obsolete. Government debt and stimulus deficit spendings were minor, distorting the whole GDP formula by transfer payments to C and foreign financing impacting I, where M is quantity of money, V is velocity, P is cumulus average price, and T is volume of goods and services. Nevertheless, knowing GDP equals MV equals PT gives us some very useful information. If we instead include both money and credit in M on one side of the equation, and additionally goods and services of T to be measured by net exports, then we can see that M and T today are heavily influenced by the financing burden of the twin deficits, which frankly, it seems intuitively obvious. The long-established Exeter pyramid may also shed some light. Everything above gold has become untethered to fundamentals, and as such is extremely fragile and exposed to any shock or unexpected breakage. The bankers and powers to be are well aware of this, would signal something has broken, which must be contained before that actually happens. In the near term, as we argued in prior videos, value is likely to start outperforming growth. Consider this equal weight S&P 500 to market cap weighted S&P. We have witnessed that market breadth is as weak as we've ever seen it, as few high-tech players have dominated market performance and market cap weighted indexes. Left behind have been players that now exhibit better value, but the money has flowed to the market cap players, which now exhibit obscene multiples. Last week I released a video with Charles Hugh Smith outlining some of the things that can soon go wrong based on false beliefs and assumptions. Markets always react strongly to discovering some belief was false. I encourage you, if you haven't already, to review the 44-minute video to see what might trigger a shift in market sentiment, investor preferences, and the powers to be into action. What are the conclusions? Policy setters are trapped on the road to a fiat currency crisis brought on by unsound money. It can only be good for may be ready for a long overdue and major breakout.